Hello guys, this is fairbinaryoptions.com, and we are continuing to build educational material on our website on www.fairbinaryoptions.com. Our previous, or the first mini project, educational project we started, was referring to the head and shoulders, and of course the inverse head and shoulder, because anything that was valid for the head and shoulder, it is valid, or it is supposed to be valid on the inverse head and shoulders as well. Those recordings are always to be found on the official YouTube channel of fairbinaryoptions.com. Also, they have been tweeted on our official Twitter channel at fairbinary, and therefore we are moving forward with our second educational project, still to be added to our playlist on the YouTube, and this one refers to a bullish and bearish engulfings. Now, this refers to the Eastern approach, if I may say so. Whenever you look at the market and you want to trade binary options, now, if you choose, regardless of the asset that you choose, let's say you choose to trade binary options based on the currency market, then the regular or the normal technical analysis was coming from the Western world, from the United States and that part of the world. However, lately I'm talking about something like 20 years or 25 years back in time, the Japanese candlestick techniques, they let's say exploded, in the sense that notions like Ichimoku Kinko Hyo or notions like reversal patterns and continuation patterns based on the candlesticks concepts have revolved and have changed the way traders look at technical analysis for good. They are coming from Japan, of course, and they date well back in time. By the time the Japanese looked at fish prices fluctuations and used these candlesticks, and all these candlesticks here, they have a name and they have a meaning. Now, we are not going to interpret them all, but one of the reversal patterns, so under the reversal pattern, okay, so let's write here that under the reversal patterns, one of the most important reversal pattern based on the candlestick techniques, it is being called bullish and bearish engulfings. Let me change the color for it. Bullish and bearish engulfing patterns. Now, what does it mean? Of course that a bullish engulfing comes after a downward trend, and a bearish engulfing comes after an upward trend. If I were to let's say point some things to consider, well, first of all, the first thing to consider is to note all the time that such a pattern is formed by two candles let me make it black. Such a pattern formed by two candles, and they need, or it is mandatory, okay, it is mandatory for the candles to be opposite. Now, what does it mean? It means that after a falling trend, if you're looking at a bullish engulfing, the second candle must be green. Bullish implies more strength to come, more upside to come. On a bearish engulfing that comes after a bullish trend, the second candle must be red, indicating future weakness to come. Therefore, in the first case, whenever a bullish engulfing it is being identified, we should engage into buying call options. And of course, on a bearish engulfing, whenever such a pattern comes, we should engage into buying put options because we're looking for price at the expiration date to be lower than the striking price. Now it depends very much the time frame such a pattern appears. The bigger the time frame or the higher the time frame, the stronger the pattern and the implication. This is a 4-hour chart on the Euro US dollar. Imagine that you will find a bullish engulfing on the weekly chart or on the daily chart or on the monthly chart, so of course the implications are higher. How does a bullish engulfing looks like? Well, a bullish engulfing is always being formed by a red candle to the downside. Let me make it red and let me make it bigger like this. A red candle to the downside followed by a green candle to the upside. Okay, bull. Anytime using candlesticks, green implies or green signifies signals bullish conditions, so price should go to the upside. Red, bearish conditions, price should move to the downside. A bullish engulfing in this case requires for price in the second candle to go minimum 50% and engulf the previous candle. So previous candle goes here, the next candle, the following candle starts here, and it is mandatory to go minimum 50%. So look for the 50% level to be pierced. This is minimum for a bullish engulfing. Ideally, a bullish engulfing should look something like this or even like this. The bigger the engulfing, the stronger the pattern. So this would be a bullish engulfing. So again, the bigger the engulfing, the stronger the pattern. Now, how about a bearish engulfing? Now, a bearish engulfing goes, and of course it is being formed out of a green candle, and this green candle, it is being retraced completely or almost completely. So price goes and engulfs the previous candle strongly. This would be a bearish engulfing. This would be a bullish engulfing. Remember, the requirement will be to be bigger than 50% of the previous candle. So let me write here that this is bullish. I will write below the candles there, as this would imply more price or more pressure to the upside. This is bullish. And of course, that this is being a bearish engulfing. And this is the theory. Now, let's try to find some examples on this Euro Great Britain Pound and see what a bullish and what a bearish engulfing actually means. And again, based on binary options, how we can trade such patterns with binary options, of course. Thank you for being here. And remember, this is fairbinaryoptions.com, and we are looking at the markets and trying to establish some educational material for our members on www.fairbinaryoptions.com. Stay tuned, please, for the next recording.